pense qu'il a encore un petit...
I think he's still got an upper hand over AI. And now I'm going to bring you back to Earth rather brutally, but there was 75,000 bankruptcies last year in France. Now, I know it's horrible. So is this due to the war, the trade war? Is it due to the war conflict? I suggest we listen to Jonathan Steenberg, who is an economist for the Coface for the UK, Ireland and northern countries. And he will share with us the prospects for 2026. Over to you, Jonathan.
Perfect. I think I have two apologies to make. One for ending the music, and two for interrupting Le Flux Français, being a non-French speaker here today. I hope, in spite of this, it will still be informative and perhaps even interesting. Let's see on the second one. In an Ernest Hemingway novel, two characters discuss how a man goes bankrupt. One asks, how does it happen? To which the other one simply says, two ways, gradually and then suddenly. It is sadly a feeling that has been echoed among several companies in the past few years. Some have succumbed to a specific shock, while others have seen a gradual erosion of their viability, a death by 1,000 cuts, as COVID, rising energy cost, rising labor cost, higher interest rate slowly and steadily eroded their margins and their liquidity. Today I'll not just discuss what our outlook is for 2026, but where we are, how we got here, and which sectors are particularly vulnerable to current shocks. Behind me you see our global insolvency index, and it tells a clear story. From 2013 to 2017, insolvencies were gradually easing, coming down after the global financial crisis and the European sovereign debt crisis. Between 2017 and 2019, we saw a period of historically low insolvencies. It was a combination of subdued cost pressures, stable growth, and exceptionally low interest rates. Not just for companies, even for SMEs. The period that followed was 2020 to 2023. Governments intervened. Cash handout, loans, grants, guaranteed insolvency moratoriums. Governments succeeded in their immediate goals, but at the same time, insolvencies were kept artificially low. That era is firmly behind us. The period that followed was one where companies had to deal with not just accumulated debt and tax obligations from the pandemic, but they also saw their costs go up, their labor costs increase, trade tensions rise, supply chain affecting them, and lastly, the highest interest rates seen in more than a decade. As a result, insolvencies rose by 20% in 2024 and a further 5% in 2025. At the same time, we have seen payment delays increase. In France, Germany, and the UK, at least 80% of companies have seen one payment delay in the last 12 months, most of them seeing an increase compared to the previous year. And that's why the picture behind me is not a surprising one. By the end of 2025, insolvencies were 25% higher than before the pandemic and at their highest level since 2013. A slow erosion, a sharp adjustment, a death by 1,000 cuts. A common observation, and to a certain degree a correct one, is that sectors move in parallel. There will be exceptions. Some sectors might do better than others, some might see a deterioration, but generally they move in tandem. This has been particularly true in the years of the pandemic. They fell together, they rebounded together. But in 2026, we expect a bit of an exception here. We expect a larger divergence between sectors. Some will benefit from some macroeconomic tailwinds, as described earlier, while others will see specific idiosyncratic pressures affecting them. Let's start with an example like the real estate sector. It's an important sector to any economy, and it's seen headwinds like few others. Higher interest rates, lower valuations, few transactions, and if so, often at a discount. This sector is still adjusting from a post-pandemic world, and several companies are still highly leveraged. But here we expect to see a divergence. In Europe, we expect a gradual recovery, whereas in the US, exemplified by its commercial real estate sector, we still expect vulnerabilities, as high interest rates and particular vulnerabilities to certain of the administration's current policies. Another sector we want to highlight is the chemical sector. It's a sector that's not just seeing a cyclical dip, but to a certain degree, a structural difficulty of competitiveness, especially when looking at European companies. They are currently operating with low demand, uncompetitive energy prices, and a complex regulatory environment. Their capacity utilization is stuck around 75%. Margins are below what they used to be. Debt is high. Compared to before the pandemic, it is the sector in Europe that has seen the sharpest increase in insolvencies. This won't be fixed this year. It takes time and investment. Another sector we want to highlight is the automotive sector. On the face of it, this might seem like a robust sector. Big brands, strong balance sheet. But if you look underneath the hood, we see the pressures. Supply chain fragility, trade tensions, high competition, to a certain degree some overcapacity, especially within the EV sector. That is why in 2025 we saw continuations of increasing insolvencies, particularly when it comes to the suppliers and service providers of the big companies. This won't change in 2026. And while we mainly tell this story in Europe and to a certain degree North America, we also want to highlight that there is a heightened competition in China as well. There's a lot of these companies competing for the same market. We're not just pessimists. There are also some sectors where we expect to see some improvements. Two examples of this is the retail and the ICT sector, both benefiting from improved consumer sentiment and higher real wages. High street retailers are, though, still struggling with previous issues. E-commerce is still rising, and they are fighting with low-price competitors, especially from abroad. And looking at the US, the increase in tariffs is clearly resulting in some margin compression among certain retailers. There is some vulnerability here. The ICT sector is one you've heard my colleagues speak about a lot today. It's a diverse sector, it's a big sector. And it's one in which we are quite confident the AI transformation will drive both winners and losers. Some companies will emerge with renewed productivity gains. Others will potentially be fighting with the potential of AI. That's not just job losses, that's bankruptcies as well. An important thing to highlight here is that with any new sector, a lot of new companies emerge. It's often said that a new sector offers a door to many, but ultimately a home to few. Simply put, a lot of the companies going in here will fail. Lastly, a sector that we also want to highlight is the transportation sector. Jean-Christophe has already highlighted some of the volatility around oil prices at the moment, but we generally do believe that oil prices will be lower this year than last year. And along with some of the previous mentioned tailwinds, we do expect this to be a sector that will benefit in 2026. Air transport is still quite buoyant. Logistics are normalizing. E-commerce is still growing. This is benefiting air transport and, to a certain degree, vehicle transport as well. This is still a highly competitive space. And while I say that transport will improve, this does not include the metro in Paris. Pardon. So what is the headline here? Insolvency risk is not uniform. Real estate struggle with valuation, chemical fundamental competitiveness issues, automotive with supply chain fragility and trade tensions. But there are also sectors that benefit, sectors that will see stabilizations or even pockets of improvements. And the aforementioned AI transformation will not just impact ICT, it will impact the wider economy. So that means across the board, there will be winners and there will be losers. Let's see, there we go. For our actual forecast for 2026, we expect a 3% increase in insolvencies. While this is less than in the past few years, it is still significant. If we look at Europe to start with, it is a region that has seen a significant increase in insolvencies since the pandemic. And it's not just SMEs. In Germany, the outstanding credit, the expected claims from insolvent companies, reached the highest level since 2009 in 2024. It came down slightly in 2025, but is still at highly elevated levels. In France, outstanding credit in insolvent companies rose for the 4th consecutive year. It is now about twice as high as it was before the pandemic. So when we expect a 1 to 2% increase in France, Germany, and the UK, it is significant. It is lower than previous because of a more stable, albeit weak, macroeconomic backdrop and easing interest rates in the UK. Spain continues to be an outlier here. We expected to see insolvencies decrease by 3% as its economic performance continues to outpace the rest of its peers. Looking eastward, in Japan, we expect a further increase in insolvencies. The country is still struggling with stagnant growth and high interest rates, both on the short and longer tenor, as well as some disruption when it comes to both trade and a heightened uncertainty around policy. Looking at the English-speaking world, where more liberal market structures meant we saw insolvencies rise quicker and more sharply, we're now seeing a divergence. In Australia, we expect a roughly stable amount. In Canada, we expect it to come down, but I want to highlight from a high level. In 2024, when it peaked, insolvencies were 75% higher than before the pandemic. In the US, meanwhile, we expect them to continue to rise by about 4%. It should be highlighted that compared to other advanced economies, insolvencies have not risen as much in the US. And the outlook here is truly two-sided, as several of my colleagues have highlighted today. On one side, we see a pretty resilient US consumer. At the same time, lower interest rates, especially on the short term, should help these SMEs that have been struggling with interest rates of 8% or higher for the past 2.5 years. But on the other side, while the overall economy is growing relatively stably, this is very much centered in certain sectors, while other sectors are struggling. And some of them are feeling these acute pressures. Higher input costs, in large degree due to tariffs, meaning several of them are not able to pass these costs on. And certain sectors are seeing quite sharp labor shortages. This is particularly true when it comes to the agriculture sector, construction, and manufacturing. The uptick we saw in industrial insolvencies in the latter half of 2025, we expect to continue, especially in the downstream manufacturers. At the same time, we do expect both construction and agri-food to continue to struggle with acute labor shortage and the ability to gain labor at affordable rates. This leads me to a last point. Something that matters not just for the year-to-year changes in insolvencies, but for the level of insolvencies. Do you remember zombie companies? It's something we spoke about during the pandemic, but also before. These are companies that operate with very, very low margins, able to cover their costs and service their debt, but little more. In a pre-pandemic world, in Europe, these companies could finance and, importantly, refinance themselves at 1.5%. So they survived. But now, the same companies are looking at 3.5% or higher, more than twice that of before. And this is the new normal. Let me illustrate this with an example. I think one that will feel at home here. Christophe, the croissant maker. You see, Christophe ran a successful bakery for decades. And in 2018, he decided to expand. He took on some debt and opened more bakeries. But then COVID happened. But Christophe survived. Then costs started rising. You see, the thing about croissant making is it's a notoriously low-margin business. Before the pandemic, Christophe made it work with an operating margin of just 2.5%, covering costs, servicing debt. But now, his bakers want higher wages. Energy costs increase. The oven is expensive just to turn on. And don't even get me started on the price of butter. Christophe is forced to raise his prices. And he does. And he maintains his margin, 2.5%. Yet, Christophe cannot service his debt. You see, to have the same underlying solvency risk as he had before the pandemic, he now needs an operating margin of at least 4%, more than 50% higher than before. And that is the key point. Because of this differential compared to before the pandemic, we now expect the underlying risk of insolvency to be about 30% higher than it was before the pandemic. So, how does a successful company like Christophe's, successful for decades, end up insolvent? 2 ways. Gradually and then suddenly. Merci beaucoup.